Hi everyone, it's Chisem. Today we're going to solving and explaining questions about chapter 24, performance measurement, compensation and multinational considerations. Let's look at the first question. As you know from the past accounting lessons, return on investment is an accounting measure of income divided by an accounting measure of investment. So we can solve the problem by dividing operating income and investment of A and B. Return on investment of A is 0.14 and return on investment of B is 0.20. Now let's look at part B. It wants to find current residual income of each division from us. As you know, residual income is an accounting measure of income minus dollar amount for required return on accounting measure of investment. The required rate of return multiplied by the investment is the input cost of the investment. The input cost of the investment is cost recognized in particular situations but not recorded in financial accounting systems because it's an opportunity cost. Front is planning an expansion that will require each division to increase its investments by $30 million and its income by $5 million. With residual income, both managers favor the expansion. The expansion has residual income of $5 million minus $30 million multiply 0.12 equal $1,030,000. And either division's residual income increases by this amount. With return on investment, on the other hand, only division A benefits. The reason is that the return on investment of the expansion is $5 million divided by $30 million equal 0.16. This is greater than the required rate of return of 12% and higher than division A's current return on investment.
Hello, I am Sıla. I will explain part C of the first question. We have just calculated the return on investment and residual incomes of the current section A and B. As stated in the question, I will calculate the return on investment and residual income of each division. If its investment is increased by $30 million and its income is increased by $5 million and evaluate it in terms of manager satisfaction. Adding $5 million to operating incomes and $30 million to investments. Extended Part A operating income of $14,800,000. The expanded A division investor is $100 million. Extended Part B operating income of $17 million. The expanded B section investment is $19 million. We apply formulas in two parts with extended values, then we look at the new and old values. Only division A benefits from the new return on investment and expansion is supported for division A. The reason is that the return on investment of the expansion is $5 million divided $30 million equal 0.16.7. This is greater than the required rate of return of 12% and higher than division A's current return on investment. However, it is below the 20% return currently planned for division B and therefore reduce the latter's overall return on investment. With the new residual income, both managers support expansion. Because the expansion has a residual income of $5 million minus $30 million times 0.12 equals 1,400,000 and either division's residual income increases by this amount.
When we look at the second question of our presentation, we see that the problem progresses in two stages. Let's read and understand the question first. Performance City supplies helicopters to corporate clients. Performance City has two sources of funds. Long-term debt with a market and book value of $34 million issued at an interest rate of 10% and equity capital that has a market value of $12 million. The cost of equity capital for Performance City is 16% and its tax rate is 40%. Performance City has divisions in two cities that operate autonomously. The company's results for 2020 are as follows. When we look at the table, we see that we have operating income, assets, and current liabilities data for New York and Chicago. And option A of the question asks us for Performance City's weighted average cost of capital. In option B, we are asked to compute the economic value added to each division. Firstly, let's calculate the weighted average cost of capital for option A. First of all, we use the interest rate times 1 minus the tax rate formula. We multiply by the issued long-term debt, which has a market and book value of $34 million. Then, we multiply the equity capital market value by the cost of the equity capital rate. And we sum these two results we find. In the end, we sum $34 million and $12 million. And we divide our previous operations by this result. Secondly, let's solve option B. When we look at the New York, we first multiply the operating income by 1 minus the interest rate in the economic value addition calculation. Next, we subtract our current liabilities from our assets and multiply by the weighted average cost of capital we find. And we subtract this result from the result of our first calculation. As a result, we have reached the economic value added for New York. And we do the same operations for Chicago, respectively. And we find the value of $523,536 for New York. And for Chicago, we find the value to be $1,145,979.
Hello everyone, I'm Saitan. Let's first understand what is given in the text, then I will solve the first question. Sangoma Products, which exports processed palm oil, operates in a variety of West African countries. The following information relates to its Nigerian division for 2020. Sales revenue $1,430,000. Plant depreciation $210,000. Other operating costs $700,000. Operating income $520,000. The division has current assets of $450,000 and one long-term asset, the plant, with a net book value of $1,890,000. The plant is 3 years old at the end of 2020 and has an estimated useful life of 12 years. The straight line method is used for depreciation and no salvage value is assumed. Over the 10-year period, Sangoma has been operating the index of construction costs in Nigeria as follows. In 2010, 100. In 2017, 150. In 2020, 180. And the first question is, what is the return on investment for the Nigerian division using historical cost measures? To find the return on investment, we first need to find the total assets. To find this, we need to sum the current assets and net book value. So 450,000 plus 1,890,000 equals 2,340,000. The formula for return on investment is operating income divided by total assets. So 520,000 divided by 2,340,000 equals 22.22%.
Hello, this is Anas. Now I will be solving the B requirement of the question, what is the return on investment for the Nigerian division using the current cost estimates for the depreciation expense and the long-term assets. Now this is an overview of the solution. In the next slides, we will go into details of how to calculate the return on investment using the current cost approach. Now to find the return on investment using the current cost approach, we will go through 6 steps, 3 of which I will be explaining, and my friend Idil will be explaining the remaining 3 steps. First, we need to restate the long-term assets from gross book value at historical cost to gross book value at current cost as of the end of 2020. The given cost is historical cost. We need to convert it to current cost. We are going to use the construction cost index to obtain the current cost of the gross book value of the long-term assets. We know that as of 2020, the construction cost index is 180, and 3 years earlier, which is the age of the asset, the construction cost index was 150. Now, by dividing the 180 by 180 and 50, we can multiply this resultant by the gross book value of the long-term asset at the historical cost to get the gross book value of the long-term asset at the current cost as of 2020. The next step is to derive the net book value of the long-term asset at cost of the end as of the end of 2020. What we are going to do in this step is we are going to subtract the accumulated depreciation for 3 years from the year of construction to the current years, which are like 3 years. To do so, we will divide the estimating remaining useful life by the estimated total useful life and multiply the result by the gross book value of the long-term asset at the current cost as of the year 2020, and the resulting number is the net book value of long-term assets at the current cost as of 2020. Now, in this result, for this number, we subtracted 3 years depreciation charge from the total or from gross book value, and we now have the net book value of the long-term assets, but not using the historical cost, but using the current cost. Next, we need to compute the cost of total assets. Now, to get the return on investment, we not only use the long-term asset, we also add the current cost or the current assets. To do so, we will use the information provided in the question, which is that the current assets at the end of 2020 is $450,000, and we will add the long-term assets from the step 2 to get the current cost of total asset at the end of 2020. My friend Idil will be explaining the remaining part of this solution. Thank you for listening.
And the next step is to calculate the current cost depreciation expense in 2020 dollars, gross book value of long-term asset at current cost of at end of 2020 dollars, dividend estimated total useful life, and hence we find the current cost depreciation expense in 2020. Well, according to our example, is 3,024,000 divided 12 equal is 252,000 current cost depreciation expense in 2020. And next step is compute 2020 operating income using 2020 current cost depreciation expense. And this is historical cost operating income minus current cost depreciation expense in 2020 dollars, and we found this is in fourth step, and minus historical cost depreciation expense, and we found a operating income for 2020 using current cost depreciation expense in 2020 dollars. And well, according to our example, 520,000 minus 252,000 minus 210,000 equal is 478,000. And the last step is calculate return on investment using current cost estimated for long-term asset and depreciation expense, and operating income for 2020 using current cost depreciation expense in 2020 dollars divided current cost of total asset at end of 2020, and return on investment using current cost estimated. And well, according to our example, is 478,000 divided 2,718,000 equal is 17.59%.
Hi everyone, I am İlker. We are going to solve this problem with together. Firstly, I want to read the problem. Vinci Corporation has a division in the United States and another in France. The investment in the French assets was made when the exchange rate was $1.36 per euro. The average exchange rate for the year was $1.43 per euro. The exchange rate at the end of the fiscal year was $1.50 per euro. And income and investment for the two divisions are as follows. They gave the information about investments and incomes for United States and France. In addition, the required return for Vinci is 11%. Calculate ROI and RI for the two divisions in their local currencies. For the French division, also, we are going to calculate these measures in dollars. Which division is doing better? Okay, let's continue with the solution. To calculate the return on investment and residual income for each division, we will use the following formulas. To find the return on investment, we divide the income by the investment and then multiply the result by 100. To find the residual income, we multiply the required return by the investment and we subtract the result from the income. According to this information, let's calculate the return on investment and residual income for each division. Firstly, if we look at the United States division, we use the formula and we find the return on investment of 13.5%. After that, we use the other formula and we find the residual income of 57,500. Secondly, if we look at the French division, we use the formula again and we find the return on investment of 13.6%. Then we use the other formula to find the residual income and the result equals to 64,900 euros. At the same time, to calculate the ROI and RI in dollars for the French division, we need to consider the exchange rates. To find the exchange rates, we have to take into account the exchange rate at the time of the investment and the average exchange rate. We multiplied the investment amount by the first rate and we multiplied the income amount by the average rate. So we found the investment and income in dollars. Later, We calculated the ROI in dollars. It is 14.29%, and RI in dollars, it is $151,840. Both divisions have positive return on investment, indicating that they are generating returns above their investments. However, the French division has a slightly higher return on investment compared to the United States division. In terms of residual income, the French division has a higher RI both in euros and in dollars compared to the United States division. To sum up, based on these measures, the French division is performing slightly better than the United States division.